Hello, and welcome back to another episode of TJ's Financial Tip of the Week, sponsored by me, your host, TJ Howe, and Triple H Financial Group, Inc., name of our company. You can visit our website at my name, tjhowe.com. That's tjhowe.com. Or you can shoot me an email if you'd like to ask a specific question. That's tj at TRIPLEH Financial. That's TJ at triplehfinancial.com. Welcome back. We've been discussing the 5 ways to help safeguard your retirement income. And just a quick recap. If you recall, topic number 1 or way number 1 was to protect ourselves from chronic health care costs, or what I refer to as long-term care costs as we get older. Do some pre-planning now so that if your health goes south down the road, you've protected yourself from those eventual costs that may come along down the road. That was topic number 1. Topic number 2 we discussed is the longevity risk we're all facing. As I mentioned, 1935, the average gentleman lived to be 66. The average female lived to be 68 years old. Well, jump forward to 2018. If you make it to 65, and I say that cautiously, but if you make it to 65, as a male, your chances of making it to 84.3 are very good. That's when you're supposed to make it. And ladies, if you make it to 65, you're supposed to live to about 86 and a half years old. Okay? So that's quite a while in retirement. So we discussed, again, keeping pace with inflation to make sure that we don't outlive our nest egg or go through it too quickly. Okay? So on to the next topic. So topic number 4, or shall I say, number 4 thing we need to address is making sure our investments grow to keep pace or stay ahead of inflation. Okay, so again, we're looking for investments that offer some growth. Having said that, though, let me say this to you. We don't want to put all of our eggs in any one basket. You remember your grandma teaching all of us that, right? Hey, don't put all your eggs in one basket. So she was right. Don't put all your eggs in one basket. But we need to remember that if we don't keep a piece of our nest egg moving forward and staying ahead of inflation, as we eat into our nest egg, then our principal is going to begin to do this, shrink lower and lower until eventually it's boom. So we need to imagine a pie. We're dividing up our nest egg into different pieces of pie, okay? So maybe this piece down here, this is going to be the piece that produces some income right now. But maybe this portion up here of the pie, we're going to leave it in a growth-oriented asset. Or maybe it's half and half for growth and half for income. But the idea is we want to be cognizant that you're going to need a piece of your pie to live on, and we want to keep another piece of the pie always sitting in a growth-oriented asset. Again, but it doesn't necessarily mean growth. Growth has to equal risk. I'm considered a safe money advisor. So for those of you out there that haven't tuned into my podcast or episode before, I'm what they call a safe money advisor. So there are 3 types of advisors. Quick recap. There are accumulation advisors, those that help you up the mountain. We talked about Mount Everest. Okay, I keep referring to Mount Everest. Well, there are those that help you up. Those are accumulation advisors. There are those that can help you down the backside. Those are distribution advisors. And there are those that can help you preserve a piece of your nest egg to pass along. Those are preservation advisors. Well, I am the latter 2. I am a distribution advisor and a preservation advisor. So I'm both a distribution and preservation specialist. So I specialize in helping you make sure you don't run out of your nest egg or your pie before you run out of breath. Okay, that's important. So one of the biggest things we can do for our assets is to keep them correctly balanced. So one of the tools we offer here at Triple H Financial Group is something called a COMRA report. So take advantage of this. Go to my website. Again, that's tjhowe.com, tjhowe.com, and I'll tell you why. Up in the right-hand corner of my screen, you'll see a Get Your Risk Score button. Click on that. That will take you to a little 11 questionnaire that is called the Color of Money Risk Analysis, COMRA, Color of Money Risk Analysis. And it will give you a score that will determine how risky or how aggressive or conservative you are. Well, once you get that score, we can help produce the report for you that will say, look, Mr. and Mrs. Jones, This is where your pie needs to be split up. You need a piece here, and a piece there. But it gives you an idea based on your score. Okay, and that's important. We kind of need to know your score to determine how risky or conservative you are. The more conservative we stay with our investments. But we're still going to pick investments and funding vehicles, safe vehicles, that allow you to still earn 2 or 3% interest minimum. Because why? That's at least what you need to keep pace with inflation. Okay? For those that are going to be a little more aggressive, heck, we can help find you things connected directly to the stock market that are earning between 7 and 9 or 10% interest. So again, depending on where you fall on the risk scale, it depends on where we guide you as to what to put your money in. Okay, so again, go to my website, tjhowe.com. That's tjhowe.com. Click on Get Your Risk Score and go through that 11 questionnaire, the COMRA, Color of Money Risk Analysis, and it'll produce a report that I can print up and email to you to give you an idea of where you need to be. Okay, so, but the point of this whole story is simply this. If you're too aggressive, you could end up losing a piece of your portfolio. So we don't want to be too conservative and not grow fast enough, but we don't want to be over the top and too aggressive, because what if the market does what it did in 2008 and we drop 36%? That means you just lost 36% of your portfolio, okay? That may not be a good thing either. So the correct word here to wrap up this episode is balance. We want an excellent level of balance throughout your portfolio. A little bit risky, a little bit safe, and a lot in between. Okay, that's can keep it growing and steadily without a lot of risk attached to it. So again, we want to keep that in mind. But just remember, you need a balanced portfolio, a balanced strategy, and we here at Triple H Financial Group can help you get there. So God bless. Thanks for tuning in, and tune in next time when we get to part number 5, which is helping to moderate your withdrawals so you don't run out of money too soon. Sayonara.